Hello everyone, and welcome to September's ACEC webinar, where we'll be discussing market volatility through a market intelligence outlook. We appreciate you all taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. At the end of the webinar, we will take the time to go through these together. Third, there will be polling questions throughout today's webinar. All results are anonymous, and we appreciate your participation. Now, I'd like to introduce our guest speaker of John Hancock, Matt Miskin. Matt is a senior capital markets research analyst where he focuses on capital markets research. His primary focus is to analyze and synthesize macroeconomic fundamentals and technical research from top-tier independent investment strategists. With strategist and asset manager insight, he leads the development of John Hancock's Investments Quarterly Market Outlook Market Intelligence. Matt received a Bachelor of Science degree in Finance from Elon University and an MBA from Babson College. He has completed Level 2 of the CFA program and holds his Series 7, 66, and 24 licenses. Thank you for presenting, Matt, and now I'll turn it over to you.
Thanks so much, and thanks everybody for being here with us. What we'd like to do today is go over the John Hancock Investments Quarterly Market Outlook called Market Intelligence. This is available on our website. It's jhinvestments.com, and you can go there to find us. We'll post this usually the second week after quarter end. And it is available to all of you. So with that, what we'd actually like to cover is we're going to go over key macro themes, things that we're seeing across the markets that are influencing asset prices and that we believe are important on a going forward basis. Then we're going to touch on U.S. equities, international equities, and fixed income, and then wrap up with some portfolio considerations. Before we go on, though, we do have a polling question here to start, and the question is, I have investing experience with stocks, bonds, international investments, and am aware of the risks associated with each. True or false? So if all of you could just go ahead and answer that, that'll be a good start to our discussion today. And I just want to give a minute for everybody to answer. Okay, and if we could take a look here and see. Okay, so about 2/3 are saying that they are, have experience with stocks, bonds, and international investments. About 1/3 saying they have not. Personally here, with over a decade of experience working on investing in client portfolios and also working on capital markets research and forecasting returns, I'll tell you that I'm always learning more about the return expectations and the risks involved with all these asset classes. So I'm always learning more, and hopefully there's some things for those that are familiar with these asset classes, you'll still learn something from the discussion that we're having today. And those that have not, there's definitely, I think, things that we're going to talk about that'll help you in formulating your asset allocation, your portfolios in your investment accounts, and that'll help you in understanding investing more broadly speaking. So the first thing we're going to talk about as it relates to market intelligence is these three macro themes. And these are key themes that we think impact and influence asset prices globally. And we think they're ones that are going to be important here as you think about asset allocation. The first is oil lower for longer. It's amazing doing these presentations, but just now, literally in the last 10 minutes, OPEC has come out and, or at least there are headlines surfacing that they might do a production freeze. Oil is rallying about 5% on the news, but still is in the mid-40 range. We're at, about $47 here on oil, and so it is modestly higher, but still that is a lot lower than it was just several years ago at about $100 a barrel. We're seeing it at the pump. Clearly oil prices are leading to lower gas prices. That's helping the U.S. consumer, but it is hurting other countries, and we're going to talk about that. The U.S. dollar staying strong, so foreign currency and the investment implications of a stronger currency domestically has ramifications for investors. So if you think about your international equity strategies or investments that you have, they can have price fluctuations based on the currency translation. So if the dollar's strong, the foreign currencies are usually weaker. That can knock off returns for your international investments, and we're going to talk about that and how to think about that. Monetary policy still steering. So monetary policy is probably the most important macro factor or important thing in the global markets today. The Fed is the world's central bank, and what they say and what they do influences and impacts returns. It impacts your fixed income, but it also impacts your equity or your stocks in your accounts. So we really want to touch on that and talk about that in more detail. One thing that may sound a little controversial, but in terms of your accounts and your investments, the Fed is likely more impactful than the president. And this election might seem like it's taking up all the media attention, and it's what a lot of us are thinking about on a day-to-day basis. But actually, it's the Fed that'll probably be more important into your returns and your account and your investments, and that's kind of what we want to focus on mostly today. But we do want to pull here. Oh, sorry. First, I want to go over this U.S. equity section a little bit and talk about the structure. All right, so U.S. equities overall, we are neutral, and I want to talk about on the right-hand side this diagram and this visual. So what we do is we work with some of the best asset managers in the world, in our opinion, and they've proven results. We also work with and we invest heavily to get access to some of the best in the industry in terms of macro research, so those that are looking at the U.S. economy and global economies, and geopolitical strategists, so those that are trying to look at the risks out there as it relates to geopolitics. And we ask them and work with them and monitor their investing to determine if they're bullish, meaning they believe that things are going to go up or outperform, in this case for U.S. stocks, or bearish, meaning that they would underperform or go down as it relates to U.S. stocks. And the color coding means the more concentration of those views. So most of these views for U.S. equities is neutral. And the way to think about that in terms of U.S. equities is, you have your investment accounts, you consider the time horizons that you're investing for, the liquidity needs that you have, the risk tolerance that you have, and other elements that formulate how you want to go ahead and set asset allocation in your accounts. And what we're saying from this, based on our network's insight, is that we would hold U.S. equities as an allocation given all those other inputs that you've already gone through and considered, and have a policy weight or a weight within your portfolios accordingly. We also like large caps over small caps, and then growth stocks over value stocks. Now, the John Hancock Investments view is informed by our network. These are these golden carrots. We're a little more neutral on growth versus value. We think there's opportunities on both sides of the styles investing, and we'll talk about that in a little more detail. Okay. So if there's one chart here that I really want everybody to consider and would encourage you, we put this chart out every quarter to take a look at, is the leading economic indicators. And what this chart shows is it's a third party it's produced by the conference board, and it shows a indication of the U.S. economy and if it's growing or if it's contracting. It goes back to the 1950s, and it's accurately predicted the last 7 recessions. Now, there is no crystal ball. There is no way of knowing the next recession. But if you know that if you have a good degree of confidence that there isn't a recession forthcoming, it would suggest that you should hold at least at a minimum U.S. equities. U.S. equities tend to do well in non-recessionary environments. They tend to do poorly in recessionary environments. This is nothing really new for most people listening, but it's just something to consider in terms of the backdrop. And what we also have here is the 10 underlying components of the leading economic indicators. The conference board, this is available online. It's completely objective. It just looks at these 10 things, sees if they're going up or down and their direction, compiles them, and then comes up with whether the overall economy is expanding or contracting. It goes back on this chart till 2000. What you can see is there's green bars, then the blue bars are preceding the 2000 recession. We've got several blue bars that gave us a forewarning. There were green bars in the last cycle. In the 2000 example, there were plenty of blue bars giving us a heads up that a recession was likely forthcoming. And then if you go all the way to the right, we can see we're still in positive territory. We are still in positive territory, but it is in a downtrend. So what does this tell us? One, it tells us that it is unlikely that we see a recession over the next 6 months in the short to intermediate term. We have to continue to monitor it, though, because it has been decelerating. There has been parts of the economy that haven't been doing as well. The energy sector is a big part of that. Lower oil prices is weighing on energy companies, and it's hurting the manufacturing sector. And so there are parts of the economy that's not doing as great, and it's something we have to keep an eye on. But if you're thinking about 6 months out, we're still not likely to see a recession, and hence the reason why we're neutral U.S. equities, that we have it as a hold in our portfolios at least, as something that we believe can generate positive returns. Okay, so the second polling question here, and I think it's very topical. With the elections nearing, how likely are you to make changes to your portfolio based on the outcome? Very likely, not sure. And finally, I will maintain the same portfolio and remain diversified. So I want to give another minute here for going ahead and submitting your responses for this question. All right. So, all right. Very likely is a 0. That's probably a good thing. I will say that geopolitical strategists do like to write about it, and there are always things to think about, but I think that for most of you, maintaining a diversified portfolio is the right, there's no right answer, but is a very logical answer, and one that we think makes more sense given if you are diversified, that will likely help you navigate any volatility that does result from the elections. But and a third, not sure. I understand that as well. And hopefully this next slide helps in thinking about it. So here, okay. So here what we did was we looked at a couple different things to think through the elections, and the first thing we wanted to do was put it in context. Okay, so the teal line is an index called the U.S. Economic Policy Uncertainty Index. It's academically driven. Basically, professors from the University of Chicago put it together, and it looks for mass media, in the mass media where the words uncertainty, the Fed, Washington, politics keep popping up. And charted over time, and this is through since 2009, and you can see that there's been many times even, that economic policy has spiked here in the United States. I mean, it's kind of, when you look back, it's kind of amazing. Since 2008, what's happened? Whether it's a double dip growth scare, that the Fed's done QE, a debt ceiling dispute, Obama was elected, so we've already had one election through this bull market. QE3 announced, the fiscal cliff, government shutdown. The government actually shut down during this bull market. To me, that's kind of amazing. The China currency devaluation, we already had a huge scare about China. Global growth fears, and just as of late, Brexit. Brexit was likely the best learning lesson that we got about geopolitical risk here, and it just happened recently. And so the other chart line on here is the purple line, which is the volatility index, the VIX. And this tends to go up when volatility goes up. And you can see oftentimes it goes up when these geopolitical risks arise. But sometimes actually it doesn't go up that much. And this is actually on a monthly basis. Sometimes volatility spikes so quickly that it ends up coming back down by the month end. So intra-month for a couple days it spikes, and the news is out there and it gets scary. But then a couple weeks later, people come back, they start investing again, and people move on with their lives. And what you've seen, if you look at the back part of this chart in the light blue, it's just the S&P 500 index. And it's just kept on going higher, even though all these things have happened. If you invested $100,000 in 2009, through 2016, it'd be worth $264,000. And it would have been through all these other geopolitical risks. So while the election certainly could add to volatility, what we're suggesting here is that owning stocks through the volatility likely makes sense, as long as business confidence and the economic fundamentals remain supportive, and we just talked about the economic backdrop with the leading economic indicators. We think stocks can continue to grind higher here. All right. The other perspective, which is a little more bottom-up in thinking, and it's more based on businesses and how they're doing versus the top-down or the politics or the overall economy. This chart looks at the net income, or think about profits of underlying businesses, and it's in different segments. They call it sectors of industry. So there's materials companies all the way down to energy companies, there's financial companies, so on and so forth. And what you can see if you look at the bottom of this chart is the energy sector, and that's the energy sector profits in the light green. And the energy sector was making about $100 billion in profits. The U.S. had gone through an energy renaissance. We were becoming a major player in producing oil. And what happened was, when oil collapsed in the end of 2014, energy companies started to lose money. And just now, they're losing about $70 billion a year in profits. And that's a huge swing. From making $100 billion to losing $70 billion is a big deal. There's other sectors here that are doing a little bit better, but overall it's also a tough environment to make money. It's a slow growth environment, but the dollar's also been pretty strong, and companies that are selling abroad, they're translating currencies at a lower level as the dollar's stronger, and that's hurting some of their profits as well. The takeaway here is that stocks tend to follow profits over the long term. If you do a chart of earnings of the S&P 500 for the last 20 years and the S&P 500, they tend to move together. The S&P will move around a lot more, the price will, than the earnings, but they tend to move together over the long term. And unless we see earnings start to bottom here, oil bottoming would help a lot, then we see more muted returns in stocks until this starts to reaccelerate higher. We could see that here in the next couple quarters, but it's something we have to continue to monitor. Across those sectors we just talked about, we think there's select opportunities, and different strategies are going to have different biases or overweights or look at different sectors, parts of the market to invest in. And this is one place we thought was interesting to visualize that. So on the vertical axis of this chart, we have the long-term earnings growth forecast for various sectors. Now, the way to think about that is bottom-up analysts give a forecast for every single company in the S&P 500. And we did that. We looked at it for each sector, so we aggregated it up for the sectors. And then we have the forward PE ratio. So the forward PE ratio is a measure of how the price to the earnings that you're paying for. So you want the lowest PE possible. You want to pay for the business earnings at the lowest multiple you can or lowest price you can. So you want to be on the left-hand side of this chart. On the right-hand side, it'd be more expensive. So you're paying more for those same earnings stream. All right, and so if you look here, you want to be in the upper left-hand quadrant, if you will. And there's 4 sectors that look better than the market. There's financials, healthcare, tech or technology, and consumer discretionary. They have what's called a lower PEG ratio, or price to earnings growth ratio. The other sectors that are less attractive from a valuation perspective are telecommunication, utilities, and staples. So it's just something to consider. You know, you got to do your homework and know what kind of sectors you're exposed to in certain things. You know, you can go passive or to an index fund, but even that, you know, you got to think about what sectors you're buying. So just something to consider here. There are different sectors that have different valuations and different growth prospects that could help your returns over the longer term. All right. If you think about the overall valuation of the market, and we just talked about the price to earnings multiple, the U.S. equity market's getting expensive. If you did current day of this top line chart, which is the PE ratio, we've actually broken out through the upside. So we're above 20. We're about at 21 today. Earnings, you know, as I showed, has come down. Prices continue to go up. And so things are kind of expensive. Now, there has been a trading range. So 16 has been on the low side. 19 was the high side. But it's something to think about, is that we're getting more expensive. And that's why we're not overly greedy here. We're not trying to be more aggressive in that U.S. equity allocation because we think that stocks are kind of expensive. If you look underneath here, what we've done is we looked at the last 2 years, if you go left to right, of annualized returns of the S&P 500, and we broke it down into 2 drivers of return. Let's take 2014, for example. So the dividend yield was about 2%. So dividends over the long term tend to be a nice tailwind to returns, and they're an important component to returns. Then you have the PE multiple expansion. So that was about 5.2%. So think about, you know, the price to earnings multiple when you bought it, and then when it ended the year, and how much that changed. Did it go up? If the price to earnings multiple went up over the course of a year, that would be a tailwind to your returns. So then that year was 5.2%. And then earnings growth. So earnings growth was 6.4% in 2014. That's great. That's a great driver of returns. That means business profits improved. Okay, let's fast forward to 2015. 2015, earnings actually fell, and we're seeing that again this year. You got dividends, which got you out of the hole, actually, which was about 2%, and you got some multiple expansion. So that actually was about a 1.4% return on the S&P 500 in 2015. This year is looking oddly enough, like 2015 in some aspects, but we're getting a lot of help from multiple expansion. So we've got 2% dividends. Earnings, it was 0.8. It's even worse than that now. It's looking more like a negative 1 or 2. But it's the S&P's up about 8% year to date. So it's been almost 10% in multiple expansion. Now, we wouldn't have forecasted this kind of strong returns this year. We would have thought it would have been a little bit lower. But nonetheless, you're still starting on these high multiples as you go out. So all in all, we're forecasting kind of a mid-single digit, I would say 5 to 10% type return environment for your U.S. equities, and that's kind of why we're more neutral. All right, let's hop now over to international equities. So international equities overall, again, we're neutral. We believe that they do warrant an allocation in portfolios. There are opportunities there, but again, it's not a place you want to be greedy. We think there are risks there, and overweighting it significantly or just overweighting it overall could increase risks to your portfolio, and that's something to consider. So let's go over some of the major elements within the international equity space. So the first one is the European Central Bank. We talked a little bit about the Fed and how much they're doing. They're starting to potentially raise rates here. We're going to see here in December if they raise rates. The European Central Bank's doing everything they can to actually stimulate growth, and this is a picture of their balance sheet. So they're going out and buying assets, financial assets in the market. Mostly it's in bonds, but it's corporate bonds, it's sovereign bonds, and they're pulling them out of the market. And what that's doing is it's inflating prices. And it's trying to push people into risk assets. And when you do that, it supports equities, it supports risk assets more broadly. It helps with people's confidence. And so it's supportive, and it's particularly the case given the Brexit vote that happened just here in June. The markets rebounded quickly off of the Brexit vote, and a real big part of that was the Bank of England came in and said, we are going to provide liquidity to the markets, we're going to be a backstop, and the markets snapped back nearly just a couple weeks. It started to build on momentum of an inflection point just days after the Brexit vote. So we think this is hugely important as a backstop for European risk assets, and part of the reason why you should hold an allocation there. Another way to look at it is that European equities have, and international developed equities overall, have underperformed the S&P 500 for the longest period in history. And I know that doesn't sound very enticing when you think about it, but markets tend to move in cycles over time. This has, been seen in history. It's just something that you'll see over and over and over again, but this is just a depiction of that. What this shows is the MSCI EFA, so that's just an index of international developed stocks relative to the S&P 500, U.S. stocks. The green bars are showing periods of outperformance of international stocks at the top. So every time you see green bars, think international developed outperforming. When you see the blue bars, that means the U.S. equities are outperforming, or said another way, international stocks are underperforming. So at the beginning, starting in 1971, international stocks outperform, then they underperform. At the top, you can see the months that it takes for each one of these periods. So, 26 months outperformance, 41 months under, 25 over, and it just keeps happening. And, just recently, if you think about it, the 1990s, 1995 to 2000, U.S. was the place to be. 75 months, it was great. International stocks massively underperformed. But at some point, there was a reversion. And then in the mid-2000s, since the end of the tech bubble to 2008, international stocks outperformed. And what you can see is after that period, in this cycle, international stocks are underperforming again. Eventually, that's going to reverse. So it's just something to think about, that the markets move in cycles, that we're at we're seeing international stocks underperform, and it would suggest that at some point they're going to be bound to outperform. On the right, we have a table, and we talk about some of those things we talked about earlier. Price to earnings ratio. So the earnings of the companies of international businesses, you're paying less for those earnings, in that relative to the U.S. where it's more expensive, it's cheaper there. The other thing is the dividend yields are higher, and in some cases they're double that of the United States. When you forecast long-term returns, your dividend return can be a huge part of that return stream. And so when you start with a larger dividend yield, that can be a big tailwind for your longer-term returns. So again, that's a reason why you would consider owning international stocks. A final thing here is the currency element. So currencies we talked about a little bit, in that the dollar's been strong, and the dollar being strong, it is hurting those that have international exposure, whether it's a business or whether it's you as an investor. When you take those returns and you translate them back to your account, to your portfolio, if the foreign currency falls relative to the dollar, then your return has a headwind. It has a depreciating component because of the currency. Now what this shows is there's hedged products out there, there's hedged investments, and it's a way to think about it is you could potentially hedge your international currency exposure. At the top is rolling 10-year periods of if you owned a hedged product or a hedge strategy, you would outperform. And those are the teal periods. At the bottom is the purple periods, which are showing unhedged. So that is basically saying if you did not hedge, you would outperform a hedged strategy. And if you go all the way to the right, you could see, all right, hedging has worked. The dollar strengthened, other currencies globally depreciated, so you did not want to have that international currency exposure. You wanted to hedge it out, and that has worked. The thing is, if you put this in context over the last 30 years, it hasn't happened that often, and when it's happened, it's not lasted a significant period of time. So our perspective is that unhedged actually longer term makes more sense, that the currencies can work in your favor, and they could actually be a return enhancer. The dollar's actually already moved a huge amount too, so the currency of those international markets may be beneficial over the longer term. All right, so now I'd actually like to switch to fixed income. And fixed income, I know sometimes it may seem less exciting than equities, but I believe that it's going to be so important for investors, especially those that, as you get closer to retirement or whatever your investment goal is, fixed income could very well be a larger part of your portfolio. But given the yields on fixed income today, it may not give you the returns that we were once accustomed to. If you think about a target date fund, target date funds increase their fixed income allocations over time so that, as you get closer to retirement, you have more fixed income. The problem is that, like I said, fixed income returns look very muted right now. On the right, we have the shading and asset class views from our network. I'll tell you now that in the most recent quarterly book that we're coming out with soon, high yield is looking to come down a bit here. We were overweight and it has outperformed, but we're going to remain positive investment grade corporates. So let's talk a little bit about all these things. So to start, I said that we're looking at a very low return environment, and if you look at this is 10-year yields across the world for all the major countries that offer debt. Okay, and it's color-coded by the credit rating. So the higher credit rating, meaning the better the credit quality, is more green, and then the red would be the more risk or the lower credit rating. And what you can see here is that there's negative yields on this chart, and I think academically speaking, that's a challenging concept to grasp. There's all these financial textbooks that are out there, speaking of the time value of money, and that, if you're going to lend money, that you should earn a return because you're sacrificing spending that money. But there's this odd anomaly right now in the market that people are giving money and paying someone to hold that money. You would think that they would just put it in a safe or put it under their mattress, but what central banks are doing today is they're causing these negative yields, and we're kind of living in an unprecedented time in history that this exists. If you look at this, Switzerland, Germany, and Japan on the right have negative yields, and that's really bringing down globally bond yields. The U.S. has a 1.5% yield, which might not sound great, but as a U.S. Citizen here and one that invests in bonds as well, I'll take it, given that there's other places that are negative. In terms of credit quality, there are places right now, if you're willing to take the risk, that you could get better yields. One thing that we think about is that there's active strategies, and to think about it, it's like, a lot of times they call them strategic income, they call them bond funds, but there's managers out there that can go across the world and find opportunities. And we do think if you do your homework, you can find some interesting ways to allocate your investments into these bond strategies that can enhance returns, but also think about risk. Again, you have to do your homework before selecting, but there are ways to add value in this kind of global space. All right. We got to talk about the Fed since we're talking about fixed income. And one thing that the Fed comes out with every quarter is this summary of economic projections. They call it the dot plot. And what we have done on this chart is shown the dot plot over time. We've also done lines showing how frequently it looks like the Fed's trying to raise rates per year. Just here in September, and we're going to be incorporating in our new book, they're looking to actually, they've lowered this. They're looking at 1 to 2 rate hikes per year. I know a lot of investors are thinking about, should I be concerned about the Fed raising rates as it relates to my bond portfolio? And it is good to think about it, but it looks like right now that the Fed's going at a very slow pace. They may just raise rates once or twice per year, that it does not look like they're going to be moving rates meaningfully higher. And as a result, we do think fixed income can grind out positive returns, a low return environment, don't get me wrong, but positive returns nonetheless, and still can provide safety in your portfolios if you look at higher quality bonds, and that can help diversify away from other risks such as equity risk or stocks being volatile. So just something to also look for here as the Fed continues to go at a very slow pace. All right, there are other factors. So the Fed's not just everything in terms of bonds, and this shows the 10-year Treasury yield and the 2-year Treasury yield. If you think about it, so your starting yield tends to be the best predictor of your longer-term returns within fixed income. If you have a high-quality bond and it does not default, and you hold it to maturity, then you should just get the coupon of that yield. So your yield is basically your most likely, your biggest component of the return. Doesn't mean it can't fluctuate along the way, and interest rate risk or sensitivity can be that thing that moves the price around of your bonds. As yields go down, that means that prices are going up, and vice versa. So if you look at this in 2013, prices went down, yields went up. We believe that prices are going to be in a range-bound environment, and therefore yields will be as well. And we outlined some of the factors that we believe are driving this. So one, we talked about it before, U.S. yields look great relative to international yields, and we think there's going to be buyers for U.S. bonds. So we just think there's a demand for that, and that's going to keep prices somewhat elevated and yields somewhat lower. There's a low growth environment, so you want to own bonds in a low growth environment. A potentially deflationary environment, globally at least, and hence bonds tend to be a good asset allocation decision in your portfolios. Some things, though, that could push rates higher over time or prices lower. One is the consumer price index continues to tick higher. This was as of May, but the September reading is 2.3%. It's a little bit higher. Housing prices and healthcare costs keep going up for U.S. citizens, and that's driving up inflation. And those two things are big parts of the core CPI or core consumer price index. So it's important, and it keeps going up, and bonds aren't a great place to be if inflation keeps going up. Your real return isn't going to be existent. You're not going to keep your purchasing power if inflation outpaces your yield. So that's one reason that bonds are less attractive. The other thing is the economy, in terms of the jobs picture, is actually looking pretty good. Over the last 12 months, there's been about 2.5 million jobs created. That's still relatively intact, even if you pull through to September. There's about 150,000 jobs per month that's being added, and we're reaching about full employment. That's a pretty good picture for the jobs market. If economic growth continues to look decent or even a little better, bond yields should rise on the margin, as a strong backdrop would suggest bonds be less attractive than equities or stocks, for example. All right. The last thing within the fixed income section to think about is asset classes within fixed income. So, I talked a little bit about equities and how there's different sectors within equities. There's different sectors within the bond market. So these sectors include the ones here in these dots, and I want to go over this chart because I think it gives a good sense of your starting yield, which is on the vertical axis here, and then your correlation to stocks. So one of the big things that you want to think owning bonds is that they provide diversification benefits in many cases to stocks. That being said, there's some that don't. So high yield, for example, actually has a high correlation to stocks, all right? So they are a riskier asset class. That being said, they have a higher starting yield. So right now, this yield's actually come down since the publication of this book. It's right around 6.5. It's about 6, let's say. So as I said earlier, though, we're saying that based on current valuations for equities, that you're looking at maybe a 5 to 10% return at best, and high yields yielding about 6. All right. So if we don't see a recession, that's a compelling return enhancer for your portfolio, because a 6% dividend yield, that'd be kicking out into your portfolio is pretty attractive. You got to weigh the risks and think about it in terms of the risk allocation in your portfolio, but it's still an interesting option. The other thing is investment-grade corporate bonds. So investment-grade corporate bonds have a lower correlation to equities, meaning that they do provide some diversification benefits, but they have a decent yield. They don't have a great yield. High yields, got almost 3 times as much yield, but they have a 2 to 3% yield, and that might not sound great, but it's better than treasuries, and it's better than a lot of the other higher quality bond parts of the market. We think they're good as a core position within your portfolio because it's a mix. They provide some downside benefits or protection if equities sell off, and they provide some return potential. So it's good in between as a starting point in your fixed income portfolios. Then you build around it all these other asset classes. These would be for your protection. These would be for your return enhancers. And that would be a way to balance out your fixed income portfolio overall. All right. To wrap up, I did want to talk about asset allocation more broadly and just some portfolio considerations. What this chart shows is on the left here, it's the forward PE ratio of various equity asset classes. The bars are representing the 10-year range, so the top would be the high of the range, the yellow would be the median. and the dots would be where we are last quarter and this quarter. What you can see in the U.S. equity asset classes is that we're at the highest point in the last 10 years. So that means you're paying as much as you've had to pay in the last 10 years, and they're pretty expensive. If you go to the right, small caps look okay. That's the Russell 2000 index. And the international markets look okay. They're still kind of expensive. They're higher than their 10-year median, but they're still not as expensive as the U.S. Let's go to bonds. This is your yield. So I said the yield was most likely your best predictor of your returns. It's also a valuation metric as a result. Well, your starting yield right now is about as low as it's been over the last 10 years. And therefore, bonds are pretty expensive too. So what do we mean? What's the takeaway from all this? That stocks and bonds are both pretty expensive right now, and it might be worth considering a third asset class or another allocation with your portfolio that has some sort of return potential, but might be driven from other factors, whether it's active management, whether it's another asset class. It depends on the investment account. It depends on your own kind of risk tolerance. You got to do your homework and find out what strategies make sense for you. But if there's a time to do your homework and try to find something, now might be the time, because these other asset classes, your kind of stocks and bonds, look pretty expensive at the current valuations. So to close up here, two last things to think about. One is volatility. We think volatility continues to be elevated here. The one thing we're watching in terms of volatility, which would be a catalyst, is the US dollar. If the dollar continues to rise, we think that volatility will rise with it. The dollar's actually weakened a bit, and it feels right now that volatility is kind of complacent. So the markets are kind of not really worrying about volatility that much. The VIX is down about here right now. And we think that, volatility could certainly elevate in the months ahead. Some things to consider, these last two bullets. So high-quality bonds are a great place to be in volatile environments. We like the investment-grade corporates, as we talked about. And then if you want to think about alternatives, you got to do your homework, but there are alternatives that have lower, we'll call it beta, but let's say equity sensitivity. So if they're not that tied to equity prices, that's something to consider. And then another thing that you might want to think about is in these volatile environments, although it's uncomfortable, they oftentimes are opportunities to allocate to asset classes that that see negative returns and that go down, and that's just your stocks or high yield bonds, the riskier asset classes. When volatility spikes, these asset classes tend to be more on sale, and they can be attractive entry points for longer term allocations. And then the final thing, inflation, like I said, continues to tick higher. Core CPI is getting driven higher by healthcare costs and housing. If you think about longer term investing for your retirements, you're going to need those two things. And if the price of those things keep going up at 3 to 4% per year, and you're saving for those expenses in the future, staying invested in a balanced portfolio, a diversified portfolio, probably makes a lot of sense. Because if you have to match those prices going up, you want your assets to go up with them so you can make those pay those expenses in the future. There are things, there's an asset classes that can be considered to try to protect from that inflationary pressures. There's Treasury inflation protected securities, or TIPS. Infrastructure has been found to be an attractive asset class over time to keep up with inflation, or just plain old stocks. Stocks tend to have a positive real return, or a return greater than inflation over the long term, and so holding some equities in your accounts tend to be able to keep your purchasing power. You still got to think about the risk and your risk tolerance, but over the long term, equities can be a positive asset class for this inflation problem that we're all facing over the longer term. So with that concludes my prepared remarks. Are there any questions?
Yeah, thank you, Matt. We appreciate you sharing your time and knowledge with everyone today. I think we have time for one of the questions that came in. So someone asked, how does the lowering of real total return of U.S. stocks affect a retirement savings and mutual funds?
Yeah, I think overall the lower return it's doing a couple things. So there are different strategies are coping with it in different ways. I think there are some strategies that are trying to take on more risk. They're trying to find opportunities to take on a bit more risk to generate more returns. In terms of what we're seeing our strategies do, it's really just finding pockets of the market that offer relative opportunities. So within U.S. equities I talked about, there's utility stocks, there's telecom stocks, or these kind of defensive stocks that have low growth potential, that have high valuations. Their dividend yields keep going down and down and down because the price keeps going up. We think there's undervalued parts of the market that have better growth prospects. Two of them in terms of the growth side, it'd be technology. On the value side, it's financials. So, tech looks great in terms of the growth prospects. Financials looks beaten up, and any time of a reversal, you could see an unlocking of value there. Within fixed income, we're not really taking a lot more risk across our platform because we think that it's not a great thing to do with the volatility that could increase, and that's why we're holding investment-grade corporate bonds as our core. We are adding a little bit of high yield to add some return potential and to get a greater yield for our investors, but we're not going out on the risk spectrum. So I think going back to what I said a couple times is you just have to do your homework, and Morningstar.com, you throw in a fund, just take a look at it, get a sense of what you own. Knowing what you own in this kind of environment of these lofty valuations and low return environment is going to be as important as ever, if not more important. I mean, I think in 2009 you could have just thrown a dart and picked anything, and for the most part of the last 7 years you would have been great. I think now, starting for the next 7 years, you just got to know what you own. Any other questions? Was there any other questions?
Sorry. Thank you again, Matt. I think that's all we have time for here today, but thank you again for presenting, and thank you attendees for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. Take care.